Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
We just talked about this. If you have an at-the-money option contract and you go out further in time, and I look at this graph, and we looked at the one-day option versus the 60-day option, if I go out further in time, I have a slower moving option contract. Two of them, by the way, because I bought one call and I bought one put. And as the market starts going up, let's say I'm correct on the news was good and the market starts going up, what happens on the way up? Well, on the way up, every time it goes up, let's look at this situation on the 60-day option. The call option goes from 50, right? I got a call and a put. On the first point movement, the put loses 50 cents and the call makes 50 cents in theory. On the next point movement, the call makes 60 cents. And the put would be the exact opposite, right? It would be 40 cents because it's got to add to 100, like we mentioned. So in the next point movement, the call makes 60 cents. The put on this situation loses 40 cents. The market goes up again. Let's say it's going to get slowed down a little bit. Let's say it makes 68 cents. Well, the put now at this point in time is going to lose about 30 cents, 32 cents in that situation. But as you see here, what I'm trying to explain is that if you're doing longer-term straddles, yes, you get slower theta decay. That is true. But your options battle each other much more in that call option has to offset all the losses that you have in the put option. And that option contract needs to accelerate. It needs to really get moving. Because bottom line is the put is really a sacrifice for the call if the market starts going up. Or if the market starts going down, right, the call is going to be a sacrifice there. You're kind of hoping that the call basically goes out worthless and you make a boatload on your put. That's your goal in your long straddle. Now, if we're looking at it closer to expiration, right, the market goes up, it goes 51, 52, 53. We see on a one-day option, this option contract, we make 50 cents in the first point movement. Boom, now we're already at 1. And almost 1 here, it's 90 cents. But it doesn't take long for the delta of that call as the market starts going up to get to 1. And every point we make 1, 1, 1, 1, 1, we already lost it on the put. It doesn't matter. So I'm not saying that there's a perfect expiration to do when you're doing long straddles. But a lot of people worry about theta and time premium erosion because they have to buy a long put and buy a long call. But bottom line is when you're doing a straddle, you're usually not going to go much longer than a week out if you're doing it around a news event, if that is your catalyst. And you have to be aware of how these options move, and the big Greek in a straddle is gamma. Gamma really drives the straddle. And I'm not a big fan of straddles. I don't do a ton of them. I do stuff a little bit more time premium neutral, I should say. Let me get to time decay. But people worry a lot more about this, and they don't think about what it does to your gamma and what it does to the explosiveness of your option. So a lot of times if I'm going to do a long straddle, this is contrary to the way a lot of other people teach it, though. I am going to look at it. I like straddles. Earnings, if I'm going to do a news catalyst, earnings are coming out this week. I got 1 week to options expiration. It's on that Monday. It's right at the money. I've gone back. I've looked at the price of the straddle at that point in time, and the straddle's $2 or $3 or whatever at that point. And if I really think the market can move that much, I'll buy the straddle. And one thing I also like to do is look at the last 3 or 4 earnings. Has the stock ever moved whatever the cost of the straddle is? And I want it to move even more than that if it can. And maybe if it's done it in the past, it will do it again. But if you look at straddles, they are risky in that you can lose your entire investment if you bet on them. And the marketplace isn't dumb. It knows what the price of the straddle should be. So they actually say, and we talk about this in the volatility webinar, or I talk about it, that most straddles are priced at a price that the stock will not move. And they'll say on a long straddles, 7 out of 10 times, the stock doesn't make enough of a movement for you to be profitable on the trade. So long straddles are, I think, the worst beginner's trade that you can do, because it's enticing and it's easy to understand. I buy both of these options. I want the market to either go way up or go way down. But the whole marketplace understands that, and they understand this catalyst that the news could create. So the options will be pricey, and they'll be priced around that event. And if you do long straddles, the concept is you got to do a lot of them. And when you make money, you got to make a lot, because most of the time you're going to lose money. Okay, this isn't a seminar on straddles, though. This is a seminar on how to use Greeks inside an option strategy. And also, I want to talk about one other thing. Right now, the weeklies are a very, very popular option contract that recently came out. And a lot of people like to sell weeklies. Now, I don't know many market makers at all, because they want to get this last week of time decay, that actually will sell anything and be naked in the last week. And why is that? Before it was called a weekly option contract, it was known on the trading floor as Gamma Week. Why? Because if you're wrong, you sell it, you get very little time premium. I keep jumping back to this one slide, but you get very little time premium. And when you're wrong and that thing becomes in the money, it goes against you very, very fast. So if you like to do weeklies, I don't mind people doing them as covered call positions, where you own the stock and it's 100% covered. And I think weeklies are very good for selling covered calls. And we have a lot of clients inside our TradeKing community, our trader network, talk about selling weeklies against their stock positions week in and week out. You get that large rate of decay. But it really scares me if you're not covered and you're thinking about doing weekly options. If you're not covered in some way, shape, or form. I don't even really like retail clients to be doing credit spreads on weeklies, because when they go against you, they hurt really fast and they hurt in a hurry. Okay, so that is a little bit on how you would use options to look at a strategy, and I hope that this gives you a good feel for that. Gives you a good feel for how to think of options and think of strategies. Think about what that Greek is telling you and what you need that strategy to do for you. I love the Theta, and this is the very close relay. I love this great rate of time decay if I'm a seller of option contracts. But also realize that this there's always a trade-off, and the trade-off is the high gamma. All right, so some people like to stay right in this range. They sell the 30-day, and when they get down to the 1-week option contract, they actually buy it back. And I have a good rule of thumb that I always put in, one of those top 10 trading papers, but I always say that if I've sold something and got 80% of the premium and I can buy it back, if I sold it for $1 and I can buy it back for 20 cents, I do it. Or heck, if I sold it for $10 and I can buy it back for $2, I do it. That's always my main rule for trading options, or selling things that are short. If I can get 80% of the credit that I brought in, I just like to buy it back, because I don't want to mess with this week where it can really go against you. Okay?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.